Good day, fellow investors. Today I opened Bloomberg and three key news are there that perfectly explain investing today, from issues in France, gold hitting 4,000 all-time highs, and also AI investments going to the trillions. So we have all these issues that will be solved with currency devaluation, therefore all assets go up, but the key question is how to position oneself now. Some say 15% gold. Let's discuss. And let's immediately start with political turmoil based on high debt, promises, entitlements, and no way to go into pain for savings. And that is not just France's issue, the same we have now in the States, all around developed countries, because simply deficits are there, continuous, somewhere more, somewhere less. Until the US dollar is the reserve currency of the world, they will be able to run these deficits. However, sooner or later, these net interest payments that are now 14% of total budget spending, 25% of budget income, which is something insane to just think about it, but that will pile up, and therefore same issues all over the place. This is back from 2023. Stanley Druckenmiller says government needs to stop spending like drunken sailors, cut entitlements. Just a note here, this is from 2023. Look at the hottest stock there. There are always these bubbles, something that might or might not be the case that we'll discuss later. Anyway, demographics bad, debts piling, interest costs rising. Therefore, there are these political issues. Solve immediately, pain now. Nobody wants pain, and there you have these clashes, political clashes, that will likely, as always, be solved with more debt and then the monetization of that debt, which means currencies are going to be devalued into destruction, as it has been the case since ever. But if currencies are going down, how come interest rates are going down? That must be a temporary bet then with all the everything bubble, because it is simply impossible that we have so many issues and interest rates are going lower. But for those who are not betting on the Fed, on governments bailing them out, a lot of them are betting on gold now, and therefore gold is at 4,000 points. Very nice chart here. Since the 2000, gold, just as gold, has outperformed stocks significantly. This is what, a 13x since 2000. It didn't outperform me. I'm at 30 something, 40, so that's still a plus for value investing. Stocks, general stocks globally, a little bit different story. But as a comment here on this Bloomberg article says, gold isn't about fear, it's about reallocation. So many are now reallocating their portfolios because currencies are gone, therefore you go into the opposite, which should be then gold or Bitcoin, whatever you prefer. So structural shift in reserve management behavior. Goldman doesn't expect a near-term reversal, so banks are buying, retail investors are also piling in, and the official sector accumulation continues for another 3 years. I love these Goldman predictions of oil at 200, but they are now predicting gold in a year or something to be close to 5,000. Then when it comes to allocation, Dalio now says to go 15% into gold from a portfolio exposure, because he says that gold is certainly safer from the US dollar and therefore a strong value at the current times that we discussed at the beginning. Budget deficits, political turmoil, political issues, you want a safe haven, and that should be gold in Dalio's words. On top of everything, as Dalio and many others say, the current stock market is expensive, looking like a bubble, and therefore again you might want to look for safety into gold. However, just a note here, I have been following Ray for now 10-ish years, and 2 years ago his suggested portfolio allocation was 7.5% into gold. 7.5% into commodities. Now that gold went from 2,000 to 4,000, the price doubled, so does he now double the allocation suggested to gold. Which means that you should have 15% of your portfolio into gold, just betting that more people will buy, because gold at the end is not doing much in your portfolio. No yield, no nothing. So that's something that always makes me think, because as value investors we look at price to value. Ray Dalio doesn't look at price. He just looks at how these things move into a portfolio, but he misses one key core component of investment returns over the long term, and that is fundamental earnings. Prices move up and down. Because if I look at gold, here he was suggesting 7.5%, here he suggests 15%, but we have seen these spikes in gold, and you can never predict when the next ugly decade or the next ugly 2-3 decades will come. This was, again, same story as now, and it ended terribly. And those buying here, yes, those had the ride of the century, but it's always a matter of price and who will buy more, not fundamentals. And this is my video from 5 years ago. Yes, I said I'm sure gold will go to 5,000. But then again, it is about how you position yourself. We invested, we made 15% per year over the last 7 years, which is, okay, gold did the same. What we did it on fundamentals, not on other people or central banks buying. That's the key difference I see here. But gold is going up. Another thing going up better than cash is AI stocks. We have now Nvidia fueling a 1 trillion AI market with circular deals. All these players are interconnected, selling to themselves and playing into what seems to be the new world. Never before has so much money been spent so rapidly on a technology that, for its potential, the key question is, of course, remains largely unproven as an avenue for profit making. We don't know what will be the profits of AI. The key is nobody knows. But everyone is betting Oracle, Nvidia, OpenAI, Microsoft, all doing deals together to be the winners there. But then again, same as with gold, what is the fundamental return on investment? Of course, if you are in the environment, if I would be Nvidia's CEO, of course I would do as many deals as possible to play the bubble as long as possible, because that gives me advantages, and no matter whether it's high or low, I should come up stronger than the others. At what level of value that will be in the future, that is the unknown. And nobody asks what is the return on investment. OpenAI does not expect to be cash flow positive until 2029, but they will invest 1 trillion until 2029. So that's something that raises a bit of eyebrows, because everything changes if they are cash flow positive by 2035. 2029, 2035, huge difference. The return on investment is halved if they hit that. Maybe never. Perhaps all these investments, what they are spending 1 trillion now, due to technological improvements, somebody will be able to do the same 5 years down the road for 1/5 of the money, 1/4 of the money. That's how technology moves. Everything becomes cheaper. There is no moat. But everything goes up, all the stocks, all the players, all the ETFs, everything goes up. And on top of that, the big companies are spending trillions into AI development, whatever, huge investment announcements. However, all these companies, Facebook, Alphabet, Amazon, Microsoft, we must keep in mind they made their money with asset-light business models. They took advantage of how the internet changed the world. They didn't build the internet. They are now building the AI, huge capex, From asset light, they are turning into high capex, asset heavy businesses on technology that gets better day by day and cheaper day by day for the same computing power and whatever. So they might be the behemoths that invested in fiber and got destroyed, and new players, asset light players, will take advantage of the infrastructure and bring to huge gains. That will again benefit society, because that's also what we discussed when we discussed David Einhorn's. So it's really hard to understand the investments, but there's a reasonable chance, and if there is a reasonable chance we as value investors don't invest, that a tremendous amount of capital destruction is going to come through this cycle. You don't want to be on this part of the equation. But Sven, who cares? Stocks go up, everybody's partying, everyone is investing, every AI announcement pushes stocks higher, and you are the idiot losing out because you are not at the party. And then Sven, there is still surely another 2x in the bubble because valuations are not even close to where those were when the dot-com crash started. Yes, okay, there is still some room here for valuations, but look at valuations in cycle downturns. So the risk is also minus 75% just from that perspective. And here also nicely written here, bubbles pop when investors realize that the lofty expectations they had were too high. So it doesn't mean that AI will not work. It just means that the return on investment expectations were too high. Then follows a period of over-exuberance that tips into mania. I don't think we are there yet, so again, another 12 months very possible when everyone is buying into the trend at the very top this year, let's say next 12 months. What comes next? Usually a slow, prolonged sell-off where company earnings start to suffer, or a singular event that changes the long-term views. The singular event that had an impact for a while, but then again, stocks can only go up so nobody cared, is DeepSeek and other models that are increasing the competition. If there is so much competition, who's the winner? The customers. Keep in mind the asset-light models of the internet and companies, not the asset-heavy capex investment. And that's something, again, that we don't know how it will work, which means this is maybe a bubble, maybe not, but certainly a bet. As they say here, telecommunication companies raced to build fiber optic networks only to find the demand wasn't there to pay for them yet. So always when it comes to this, do they have a moat, or can somebody maybe in 5 years build same needs, what you need actually to make money with AI? I use AI, really nice, but how much am I willing to invest in it? That's a different question. And stocks just keep going up based on promises AI. However, even Jeff Bezos says that AI will be great, but the returns will not be equal for all. The industrial AI bubble could lead to lost investment, but will also make society better off. Of course, we are better off thanks to the internet. You can enjoy my videos, which wasn't possible 25 years ago. However, that is also the key core of this video, price and value. We have a hard time distinguishing between good ideas and bad ideas in the middle of excitement around artificial intelligence. So that's the key, the disconnection between value, price, cost and return. Starting from the deficits, what's the cost of those deficits in the long term? Does it outweigh the current benefits of keeping the baby boomers happy with entitlements? That's the key there. Same with money, bonds, currencies, supply and demand. But what is the true return of fundamentals? Gold, no fundamental return, just others buying. AI, just playing the momentum exuberant. Momentum goes up, momentum goes down. I don't want to be on the other side when it goes down, so I'm missing the party when it goes up. But it's extremely hard to fight this 2x Tesla stock to the moon syndrome. Total Tesla profits are 25 billion since the IPO, compared to 1.5 trillion market capitalization. And there sure will be winners. We just don't know who and when. Not everyone. I will be focusing on price. I did outperform gold over the last 20-something years. I'll keep focusing on price, keep focusing on the things that work, no matter what is going on in the environment. Dividends, buybacks, businesses, moats, growth, no matter what. I'm unlikely to make any bets. If so, I will buy Alibaba at 80, a good position, and then sell at 175 like last month because, okay, I made my money on AI, then we go next. And if we look at our investment quadrant, when it comes to stocks, oil, AI, no AI, still will be there, fertilizers, but then you also food, Verizon, dividends, high debt, home buildings. So you have to see, okay, what's cheap, what's a little bit playing there. We'll discuss Nomad tomorrow, things like that, the dividends there. So can I invest with a margin of safety? I always say, check my research platform. There are the real value investments with the margin of safety, 21-day money back guarantee. You can check my performance here, the research platform. And that's the best value I can give you now. Thanks for watching. I'll see you in the next video.